Hello everyone, thanks so much for joining. I thought I'd do a quick video to explain which liabilities are considered fixed income instruments. First of all, what are fixed income instruments? You hear fixed income instruments potentially many times. Fixed income instruments are financial securities that provide regular, predictable payments or income to the investor, typically in form of interest, when we look at the bond coupon payments. These instruments are a type of debt investment, meaning the investor is actually lending money to the issuer, which could be a government, a corporation, or another entity. Yeah, and we call it fixed income because we have those regular payments, those coupon payments. They are quite predictable because we have a contract in place, and also when we talk about debt instruments, because of the indenture, which is the bond contract and other contracts. If you go to the bank and ask for a loan, usually there's a contract in place where the issuer is obligated to make those regular payments. That's why we call it fixed income instruments. However, I want to give you a little bit of different view for you to navigate, okay, what are fixed income instruments and what potentially not. If we look at the balance sheet of a company, balance sheet, we have short-term assets on the asset side, long-term assets, and then on the liability side, we have short-term liabilities. We have long-term liabilities, and we have equity. Yeah, and then, as you know, the left side equals with the right side. Good. If we look into our liability section, because fixed income, we're talking about debt instruments, we are talking about liabilities, we're not talking about equity. You have a few short-term and long-term liabilities. You have, as you know, accounts payable, short-term liability. You may have lease liabilities. You may have accrued payroll. If remuneration or salary has not yet been paid, then you have deferred revenue. If the customer has paid you already, but you have not delivered the service or the product. Taxes payable, you need to pay taxes, which is a liability, it's an obligation. Then you have potentially pension liabilities. Then you have loans and you have bonds. Yeah, and in general, these are all liabilities because, as accounting standards define, it's a present obligation to transfer economic resources as a result of past events. So these are all liabilities. And think about this just for completeness. These are your obligations to your suppliers. These are your obligations to your lessors, if you have any. These are your obligation to the retirees. These are your obligations to your banks. These are your obligation to your debt investors. These are your obligations to employees. These are your obligation to your customers. These are your obligations to the government. Yeah, and if we think about fixed income, then I would consider those. Many of the other instruments and liabilities, especially especially lease liabilities and pension liabilities, they share similar characteristics, but if you see any textbooks or any studies, usually you can think about these categories as fixed income instruments. Yeah, I hope you found this useful. Quick video. See you in another one. Thank you so much for watching. Bye.